One of the most essential things we must provide for ourselves is shelter. We need a comfortable place to call home and to look after our families. However, have you thought about certain factors that could possibly skyrocket housing costs and make it incredibly difficult for many families to find or retain a home? This is a major concern at the moment. Top investors and stakeholders in the real estate market, including Warren Buffett, have their respective thoughts about this and perhaps a feasible way forward. Well, here's the thing. As you hope to make better decisions concerning your housing provision, it's important to consider the volatile economy of the country and the uncertain future of the real estate industry. Before we proceed, ensure you subscribe to our channel and hit the like button for more insightful content like this. Let's travel back in time a little bit. In 2008, the US housing crash was a financial crisis triggered by a housing bubble, subprime mortgage lending, and the subsequent collapse of mortgage-backed securities. It led to widespread economic downturn, impacting various sectors and causing a global recession. This housing crash in the US had multiple interconnected causes. One key factor was the housing bubble, where home prices soared to an unsustainable levels due to speculative investments and risky lending practices. Financial institutions engaged in subprime mortgage lending, offering loans to borrowers with weak credit. These subprime mortgages were bundled into complex financial products, such as mortgage-backed securities, which were traded on global markets. When a significant number of subprime borrowers started defaulting on their mortgages, it triggered a chain reaction. The value of mortgage-backed securities plummeted, leading to massive losses for financial institutions. This crisis spread to other sectors, causing a credit freeze, widespread economic downturn, and contributed to the global financial crisis. At the time, this housing crash in 2008 impacted various groups. It significantly impacted homeowners, leading to widespread foreclosures, declining property values, and economic challenges. Many individuals faced housing insecurity, financial losses, and difficulty obtaining loans. The broader economy also suffered, as the crisis contributed to a recession. Government interventions and regulatory measures were implemented to address the aftermath and prevent similar situations in the future. Even when mortgage rates shot up to 8% in October, their highest levels in over 23 years, home values remained stable. The shortage of available houses is the problem. With only a 3 to 6 month supply, according to the NAR's October report, inventories are still incredibly low. Head of the lending company New American Funding, Rick Arvielo, predicts no drop in home prices. The inventory is simply insufficient, he said. The head economist at Zillow, Skylar Olson, concurs on the mismatch between supply and demand. As per her most recent prediction, house prices would continue to climb until 2024. This is a good news for sellers, but it's not so good for first-time buyers who are finding it hard to become homeowners. Olson asserts, we're not in that space where things are suddenly going to be more affordable. In fact, recent months have seen quite the opposite. As per Realtor.com's October 2023 Housing Market Trends report, high mortgage rates have raised the monthly cost of financing the typical home, after a 20% down payment, by 7.4% since last year, which translates to $166 more in monthly payments than a buyer would have paid in October last year. Considering all of this, housing economists and analysts concur that market correction is likely to be mild. Nobody anticipates price declines comparable to those that occurred during the Great Recession. Now is the time to address the big question. Will the housing market crash? Probably not. Since there are still more buyers than sellers, a significant drop in price is not possible. Title Insurance First American Financial Corporation's senior economist, Mark Fleming, states that there is just generally not enough supply. There are more individuals than there are available homes. It's 101 econ. The market has been distorted. According to Dave Laniger, the founder of the real estate company RE/Max, by the significant increase in mortgage rates. Many prospective homeowners have been waiting for mortgage rates to go down. But if they do, a wave of new purchases may enter the market and drive up the cost of homes. According to Laniger, you have a generation of unmet demand. The interesting situation we find ourselves in is one of extreme demand and insufficient inventories. When interest rates do eventually decline, it'll be another boom and burst circle. The American housing market appeared utterly exuberant between 2005 and 2007, but then home values fell with terrible results. The world economy entered the worst downturn since the Great Depression when the real estate bubble burst. Buyers and homeowners are wondering when the housing market will crash because the current housing boom is now in jeopardy due to rising mortgage rates and the possibility of recession. Bankrate's most recent expert survey pegs the odds at 46%. Housing experts concur that there won't be a crash, though as prices may drop, albeit not to the same extent as they did during the Great Recession, the personal balance sheets of homeowners are significantly stronger now than they were 15 years ago, which is one clear distinction between the two periods. The typical homeowner with a mortgage has excellent credit, a significant amount of home equity, and a fixed rate mortgage with the rate locked in at less than 5%. In fact, 82.4% of all current homeowners have a mortgage locked in at less than 5%, citing a recent Redfin research. Also, builders have been careful in their pace of construction, since they are all too familiar with the effects of the Great Recession. There is a persistent lack of available properties as a result. Yun states, "We just don't have the inventory." Will there be a drop in price in some markets? Indeed. However, it is quite doubtful that there would be another 30% price drop given the lack of supplies. To sum this all up, let's take a look at current home prices. The housing market would eventually cool, according to long-held predictions by economists, as home values become victims of their own success. According to NAR, the median sale price of a single-family house is rising once more, with a 3.4% annual gain in October, following a year-over-year loss in February, the first yearly decline in more than a decade. That is an increase from the previous year for the fourth consecutive month. Even if the home market is slowing down, this slowdown doesn't seem to be similar to previous real estate downturns. Even while prices are high, fewer properties are really being sold, and the number of available homes has also substantially decreased. The availability of homes for sale is even more limited as a result of homeowners who locked in the 3% mortgage rates of a few years ago, declining to sell. Who can blame them, considering that current rates have reached 8%? Because of this, the correction won't resemble the complete collapse of real estate values that occurred during the Great Recession, when certain housing areas saw a 50% decline in value. More importantly, there are certain measures that should be taken to ensure that the 2008 housing crash doesn't repeat itself and ruin the economy. Ideally, some steps that should be taken include financial regulation, risk management, interest rate policies, regulatory reforms, housing supply increases, government subsidies, debt restructuring, and a lot more. For example, we should implement and enforce regulations to monitor lending practices, ensuring responsible and transparent mortgage lending to prevent the formation of housing bubbles. There is a need to also improve risk management practices within financial institutions to prevent excessive exposure to high-risk assets and ensure the stability of the financial system. As for interest rate policies, we must adjust rates to stimulate or cool down the housing market, depending on economic conditions, to encourage or discourage borrowing. Regulatory reforms is another crucial area to look at. We must strengthen regulations on lending practices to prevent risky behavior, ensuring that mortgages are issued responsibly and transparently. To ease tension, the government should introduce subsidies or tax incentives to make home ownership more accessible, particularly for first-time buyers. People should also be encouraged to invest in affordable housing. This is possible when there's increased funding for affordable housing projects to address the shortage of affordable homes and providing housing options for a broader range of income levels. Lastly, job creation and economic stimulus are essential. We must implement measures to boost overall economic activity, creating jobs and supporting household incomes. Over time, this will certainly benefit the housing market. Remember, the effectiveness of these measures depend on the specific circumstances of the housing market and the broader economy. Combining short-term relief with long-term structural changes is often key to sustainable recovery. Was this video insightful? Don't forget to subscribe, like, and share your thoughts in the comments.